In today's market update, we're going to be focusing on only one market, the S&P 500, using SPX data, because I want to discuss what happens when we experience cycle wavelength variation and how we can still make confident trading decisions even though there is a big variation in cycle wavelength. Here is the analysis we've been tracking for many months in the S&P 500 looking at SPX data, and you will know that I consider the trough that formed in October of 2023 to be of 18-month magnitude. There is some debate about that amongst Hurst cycles analysts because it is also possible that that could be a trough of the 40-week cycle as opposed to the 18-month cycle. How is it possible that there is such a difference? When Hurst defined his nominal model, which is the list of cycles that we use to perform our cycle analysis of the markets, he averaged the wavelengths of the cycles that make up that nominal model. And the average length of a 40-week cycle is 272 days. The average length of an 18-month cycle is 546 days. However, he also defined the principle of variation, which tells us that various aspects of these cycles are subject to variation, and, most importantly, the wavelength of the cycles is also subject to variation. And so if we zoom out and measure the number of bars from the 54-month or potential 54-month cycle trough that formed in October of 2022 to this 18-month cycle trough that formed at the end of October last year, you will see there were only 378 days. Is that a long 40-week cycle, or is it a short 18-month cycle? That is a debate that continues to rage in Hurst cycle analyst circles. I prefer the analysis that considers that to be an 18-month cycle trough as opposed to a 40-week cycle trough, and one of the reasons for that is because of this strong upward movement that we have experienced. That very bullish upward movement could be the rise out of a 40-week cycle trough, but it makes more sense to me to consider that as a trough of the 18-month cycle. Now, by positioning the 18-month cycle trough over here, what we have had to do is compress these shorter cycles. In other words, all cycles shorter than the 18-month cycle must be compressed. They must be phased with shorter wavelengths. The result of that is that when we consider the recent wavelength of each one of those shorter cycles, we end up with a shorter recent wavelength. And that is why this circle for the 40-week cycle trough is floating over here at around about this time now. But as you will know from recent market update videos, and if you haven't been tracking the sequence of these update videos, I would encourage you to go back and take a look at them, because understanding how a Hurst cycles analysis develops over time is a really important aspect of this approach. You will know that we have been considering this trough over here that formed in the middle of April as a trough of the 20-week cycle, which, as you can see, it has been phased as in this analysis. However, you will notice that the whiskers of this circle and whiskers for the 40-week cycle are overlapping that 20-week cycle trough, which raises the obvious question: is this possibly a 40-week cycle trough that formed over here, or is it, as presented in this analysis, a 20-week cycle trough? If we count the number of days that elapsed into that potential 20-week or maybe 40-week cycle trough, you will see 175 days elapsed. The average length of a 20-week cycle is 136 days, which would have been over here in the middle of March. And if you go back to the market update videos we were recording at that time, you will see that we were anticipating and for some time discussed the possibility that a straddled 20-week cycle trough was forming at this time in the middle of March. It is now fairly obvious that the 20-week cycle trough did not form in March, but in fact did form here in the middle of April. But again, we are presented with an awkward in-between time for the wavelength for this cycle. 175 days is a bit longer than 136 days, making this a long 20-week cycle. What about the possibility that it is a 40-week cycle? Well, the average length of a 40-week cycle is 272 days, which would position the trough over here towards the end of July. It is more likely, in my opinion, that this is a 20-week cycle as opposed to a 40-week cycle. But why do we have this confusion on our chart? It is because of the principle of variation and the changing cycle wavelengths. So how do we deal with it? This is the approach that I take. At some point we have to put pen to paper and we have to say that we believe this is a trough of a particular cycle, which is of course what I've done here, not putting pen to paper, but I am using the software to digitally put pen to paper, and I am making a commitment in terms of this being a 20-week cycle trough. We have a very straggly nest of lows for the 40-week cycle, which you can see is being stretched out with the circle of the 40-week cycle over here round about now, and the shorter cycle stretching this nest of lows all the way out to October. Where can we expect the 40-week cycle trough to occur if the 20-week cycle trough occurred in the middle of April? What is happening, in my opinion, is that the cycles are undergoing some quite strong variation. That happens when a major cycle trough or peak forms in the market. And so working with the recent average wavelength of these cycles becomes problematic, because if a big change has happened in those cycles, we cannot see it in those recent average wavelengths. And so what I do is I tend to ignore the confusing longer cycles and focus instead on the near-term picture. So the first thing that we're going to do is we're going to work out when we are likely to expect this 40-week cycle trough to occur. Cycles form M shapes in markets, and so in terms of the bigger picture, what we have witnessed here is the first half of an M shape, with price rising to the first peak and then dropping to the midpoint at the 20-week cycle trough. There are two options in terms of what could happen now. I've discussed this in previous market update videos. The first option is that we get an extended move up to the second peak before price drops down into the 40-week cycle trough. The second option is that we get a more symmetrical price movement. Let me change the color of the pen and demonstrate what a symmetrical price movement would provide us with. It would provide us with a move up, as we have seen here, with an earlier peak forming and then price moving down more strongly into the 40-week cycle trough. I present both of these options because we are not fortune tellers. We cannot see the future. We can expect one thing, but we need to be aware of the possibilities. And both of these options at the moment are possibilities. The important thing to determine initially is when we are expecting this 40-week cycle trough. Having determined possible points of time in which we could expect that 40-week cycle trough, we will then be watching the markets closely to witness the point at which the peak forms. It will either be an early peak or it will be a late peak. So our first step is to determine possible positions for this 40-week cycle trough. Our second step will then be to monitor price action to determine where that peak is coming in. I should point out that markets, a little bit like a fair system of justice in which one is innocent until proven guilty, should be considered to be bullish until proven otherwise. And this is indeed a bullish market. There is no question about that. We have experienced a bullish 20-week cycle that elapsed over there. This market so far is still bullish, and so at present we are looking for a later peak and a continued bullish move before price turns down into this 40-week cycle trough. This market is bullish until proven otherwise. So in a moment we will take a look at how we will find evidence that the market is beginning to turn bearish, which it is not yet. So how can we determine where the 40-week cycle trough is likely to form? The first potential position is to measure 272 days from the trough in October of last year. That positions us over here in the last week of July. So let's make a mark over there. This is one potential position for the 40-week cycle trough. Notice in the shorter cycles that it is above this 80-day cycle nest of lows. The next possible position for that 40-week cycle trough is to measure forward the average length of a 20-week cycle from the most recent 20-week cycle trough. That is 136 days forward from the middle of April, and that positions us right over here at the beginning of September. And so we'll make another mark over there as a potential position for that 40-week cycle trough. A third possibility is to assume that the 20-week cycle is going to beat with exactly the same wavelength again, 175 days. That means that the trough will occur at 350 days following the trough in October of last year. That would place it over here in about the middle of October. And so our final potential position for the 40-week cycle trough is over here. At this point, some analysts try to find ways of resolving those three potential positions. In my opinion, that's very difficult to do because, as I've already mentioned, we're not fortune tellers. We don't know which of those options are going to turn out to provide the exact time for the 40-week cycle trough. At this point, I zoom in and I hide the longer cycles and consider the shorter cycles, which of course are using information that is more recent. We are expecting a 40-day cycle trough, as you can see, about the end of this week or perhaps early next week, or potentially, here is the whisker for the 40-day cycle trough. It could have occurred as early as last week. And so the 40-day cycle trough is the next thing that we are expecting. Then we have a nest of lows for the 80-day cycle trough, which is over here in about the third week of July. As I've already mentioned, that is a potential time for the 40-week cycle trough also to occur. We need to keep our eyes open for the formation of perhaps a fairly strong trough at that time. But as mentioned, this market is bullish until proven otherwise. So how do we prove it otherwise? We watch our cycle tools very carefully. In this case, I'll be watching the 20-day cycle FLD, which you will know is one of my favorite FLDs to watch. Price crossed up above this 20-day FLD over here at the end of April. It reached up and achieved its target at about the time of the formation of the 20-day cycle trough, which you can see, according to this analysis, was this rather subtle little trough that formed over here about 2 weeks ago. At about that time, price would be expected to find support at the level of the 20-day FLD. It didn't get anywhere near to the 20-day FLD, you can see over here, which provides us with further evidence that this market is bullish. It is also, of course, possible that the 20-week cycle trough did not form over here, but in fact formed earlier. Perhaps it was an early 20-day cycle trough over here. Nevertheless, the evidence so far is all in favor of this being a bullish market. What are we expecting to happen now? If the 40-day cycle trough still lies ahead of us, we would expect price to cross down below the 20-day FLD, generate a target to the downside, at which point the 40-day cycle trough would be expected to form. It is possible that it might do that. Notice how the 20-day FLD has come up because it is simply a repeat of the median price, and so even if price crosses below the 20-day FLD today, we would generate a fairly insignificant target to the downside. That is one possibility for the 40-day cycle trough. The other possibility is that, of course, this trough that formed on Thursday of last week is in fact the 40-day cycle trough. It formed at 34 days after the trough in the middle of April. The average length of a 40-day cycle discovered by Hurst 50 years ago is 34 days, making it quite possible, if not likely, that the 40-day cycle trough did in fact form on Thursday of last week, What about the fact that we expected price to cross down below the 20-day FLD, generate a target and so forth? That is only an expectation. If the 40-day cycle trough did form above the 20-day cycle FLD, that is yet further evidence that we are in the midst of a bullish market. And so, with the evidence on the table so far, we are still in a bullish market. We might experience a 40-day cycle trough lying ahead of us, but it is also very possible that that 40-day cycle trough has already formed. We need to turn our attention towards a trough forming in the third week of July, but until then, this market is bullish until proven otherwise. I do hope you found this market update useful and interesting. If you have any questions, please put them in the comments below the video or join us on our Hurst Cycles Discord server. I look forward to hearing from you.